Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and co-founder of Moore Squared Communications. Each episode, we welcome a guest to the show to share their news story of the week. And this episode, I'm delighted to welcome Jennifer O'Neill, partner at Aon's investment practice, to the show. Welcome, Jennifer.
Thanks, Charlotte. It's great to be on the show.
Lovely to have you on the show. Do tell us, what is your news story of the week?
This week, my news story is the FT's article published today, Monday, 3rd of March, on how big is the stock market's America bubble.
Yeah, it's a great story. I mean, I want to ask you, why do you think this would be of interest to investors? But that seems a slightly redundant question, really. But do tell us, what was it about this story that caught your eye?
Well, for me, Charlotte, this really captures a lot of the narrative over the past 12, 24, 36 months about the way that equity markets are developing, the way that stock markets are exhibiting degrees of concentration, whether that's sectorally or indeed by company, and really bringing that all together. So I thought it was very topical.
Yeah, it certainly is. And it just seems that those tech stocks and AI just seem to become larger and larger and larger in terms of market cap and take up more and more of the index as a result. I mean, the title says it all, how big is the US stock market bubble, which obviously is a very strong indication that the FT thinks that maybe these stocks are overvalued. So would you agree? Do you think these stocks are overvalued?
It's a really interesting question. I'm going to come at this from a couple of different angles, if I may. So
absolutely.
If we think about that concentration point, first of all, so how much does the US represent of global stock markets? We have seen a rising concentration of US equities making up that global market cap, particularly in developed markets. So there is certainly that rising trend. But I think if we look at this in a couple of different ways, that picture becomes slightly less black and white. So that's what I'm going to try and unpack over the course of our discussion today.
Okay,
now,
so
let me perhaps pick up on your question about valuations. And if we look at that first of all, the key thing that I do want to emphasize is that whether we're talking about these large mega cap, AI-driven or tech-driven stocks or others within the broad market index, these are profitable companies. And if I can break that down and just give a bit of an example of what I'm speaking about here, all of the numbers I'm talking about at the moment are to the end of 2024, as we don't yet have quarter one end data. So over the course of the 3 years to the end of 2024, US stock markets were up just under 100%, so 97% total return. Now, the key thing I want to bring out here is that there has been a bit of a prevailing concern about multiple expansion, so things getting more expensive. But when we break it down, 75 to 80% of that total return actually came from earnings growth and dividends. So 20%, yes, did come from multiple expansion, but by and large, these are profits that are being generated for shareholders. So I think that profitability story is really strong. And that's certainly the case when we look at the Magnificent Seven, representing a large proportion of the US stock market, and indeed the top 10 stocks in that market. These are profitable companies, astronomically so. So it isn't necessarily the case that this is simply a frothy bubble whereby markets are simply getting more expensive with nothing to show for it.
No, I mean, there is that famous kind of like metric, which seems a bit, I'm almost embarrassed to use it because it's such a sort of hackneyed metric when we talk about PEG ratios, which is the price to earnings ratio of a particular stock relative to its growth. But it is quite a handy shorthand, isn't it? Because a PE can be high, your price relative to earnings can be high, as long as you think that the future growth rate is also going to be high. So I guess that's the question. At the moment, these stocks have so far delivered on that, as you say, 75 to 80% growth coming from earnings and dividends. But how confident are we that they're going to be able to continue to grow? Because the bigger you get, the harder it is to continue to grow because you're adding to an already very, very big number.
Yes, of course. And also another dynamic we began to see over the course of this year was the emergence of challengers to that. So if we think back to DeepSeek, the reaction in NVIDIA's stock price was quite marked, as well as other ancillary second and third order sectors. So I found it really interesting, actually, that the buildings and materials sectors came off quite heavily after the DeepSeek news on the assumption that cheaper access to AI pointed to less investment in data centers, so less demand for construction and materials. Those second and third order effects are very, very interesting in the context of this AI story. So it's not just limited to one sector. I think that's a key point as well. Equity markets are very well connected, and we often see those interlinkages come to pass during times of volatility.
So do you think that we're still justified in kind of basically pinning, it feels like we're pinning all of our growth hopes on technology, on AI. And I'm old enough to have lived through the 90s tech bubble. Maybe I shouldn't say that in public, but I am. So I remember some people talking about paradigm shifts then and all the rest of it and dot-com booms. So is that justified, or are we being almost a little bit lazy because we can't really see where else the growth is going to come from? So we've kind of latched on to the easiest narrative around tech and AI.
It's a great question. Just if I could pick up on the point around the tech boom and the dot-com bubble, the counterpoint I would raise there is that those companies were not profitable. Many of them were hopes and prayers without any earnings, let alone strong earnings. So I think we are in a very different environment now where we are seeing that huge profitability story come through. So that is a bit of a different market environment, I would suggest. It is an interesting question around whether this is becoming a very crowded trade. Now, going back to the point around volatility, what we often see, of course, is that when markets are narrow, then when we want to get to the exit door, it's very difficult to do so, and we see a very strong market reaction. But the point I would make on that is that we are actually seeing quite a lot of market breadth here as well. So returns, whilst they are being helped and supported by those top 10 stocks, as the top 10 stocks in the S&P represent around 30%. Sorry, that's the Magnificent Seven. The top 10 represents around 38% of the S&P. But we are seeing market breadth. So we are seeing all sectors in the S&P reaching all-time highs. We're also seeing that in other regional indices. European banks have done very well, for example. Financials aren't typically a sector that performs especially well when we are concerned about risk of recession and risk of equity market falls. So we are seeing a lot of breadth both regionally and sectorally, and I think that's a strong message to take away.
But in terms of the growth, I mean, we touched on that before, and I mentioned that if you're very big, then continuing to grow can become very difficult. Do we feel confident that the growth is still going to be there, or do we feel that, I mean, we could use... well, obviously, this was my sector when I was an investment analyst, but we can use a sort of pharmaceutical biotech analogy in that big pharma became sort of moribund around the turn of the century, around 2000, and it's become increasingly reliant on biotech for innovation. Could we see something similar happen where these large tech companies become growth moribund and they become very reliant on the younger companies coming up with the new tech that they can then hoover up once it's proof of concept? Do we see something similar happening there?
I think over a long time period, we may see that coming through. I don't think we are seeing that yet. So I think we are still at a point where we are seeing earnings surprises on the upside, and we are seeing that earnings expectations are increasing rather than being pared back. So I don't think we're at that point yet, but I do agree that over a long time horizon, it is very difficult to sustain these levels of growth. And so from an investor's perspective, being aware of how the market landscape is changing and what other tools you have in your toolkit to be able to navigate through that over the time horizon that's relevant to you is really, really important.
I think we've talked a lot about valuation there, and I think we've talked about growth, which obviously is all wrapped up in the valuation argument. Let's talk a bit more about concentration risk, because actually the first episode that we ever did of this podcast with Dan Mikulskis was the story of the week was NVIDIA had actually collapsed. It wasn't DeepSeek, it was long before that. Mm-hmm. And we got into an interesting conversation about concentration risk. So I think you can think about concentration risk in two ways, right? It kind of depends on your investment horizon. If I'm a short to medium term investor, then I should be quite worried about concentration risk, because if there is a sharp market correction, it can take a long time for that to recover. And I can nurse a 20 to 30% down, disappearance of the capital value of my portfolio. On the other hand, as we're talking about professional investors in this podcast, by which we mean people with very long time horizons, pension schemes and insurance companies, often up to 40 years, do we really care? There are obviously the people who are just about to retire that are going to be impacted by that, but where you can argue it from both directions, where do you sit on that kind of continuum of worrying about concentration risk, Jennifer?
Yeah, and just to that point, just on investors' time horizons, I spend a lot of my time working with organizations that effectively have a perpetual time horizon, or one that is upwards of 100 years, which may as well be thought of as a perpetuity. So that really does have an impact. And I think that's an important point when thinking about what a strategic asset allocation looks like. Perhaps if I give my lens on this and delve a little bit deeper into the concentration question, from my perspective, we are in an environment which is fairly supportive of continued equity market returns over the medium to long term. We may, of course, see short-term volatility, as we did over the month of February, for example. So we may well see that, particularly as geopolitics is coming to the fore. Trade wars and tariffs are two of the T's out there, but there is also the third T, the Trump factor, which is present in markets. That represents a short-term potential source of volatility. But over that medium to long term, equity markets look fairly well placed to continue to deliver returns. There are no immediate signs of recession conditions emerging in the US or in other large developed economies. So that is a supportive environment. Now, on the concentration point, there are two lenses I'd like to pick up here. One is that regional market concentration. So we talked about this at the beginning. The US represents a growing proportion of global market cap indices. Now, again, any investment decision is an active one. And so I've got a bit of a bugbear about using the phrase passive investing to refer to investing in any index tracking fund, because your choice of index is an active one. Mm-hmm. And if we were to look at another index, so S&P Global, the index organization, also publishes the Dow Jones Global Index. Now, the US represents circa half of that index. So there are ways and means for an investor to make a decision about how comfortable they feel on market concentration through their choice of index. You could also look at equal weighting, for example, or factor-based investing, and selecting the factors to which you wish to be exposed. That's one lens. If I could briefly touch on the second lens, which is about stock concentration in markets. I mentioned that statistic a little bit earlier on, about 38% of the S&P 500 being made up of the top 10 names. Now, when we look at other regional indices, that's actually quite low. So if we look at of the other 20 large developed market indices, that 38% figure is lower than all but two of those. Mm. So I think that is an interesting point, because actually the average level of top 10 concentration in those other regional indices is 58%. So the US looks quite benign by comparison. So again, it depends on what you're looking at and the comparators that you have. And I think this is an important point around investing in general, is that there is always nuance to the decisions that we make and the data that we evaluate in making those decisions. So I hope this is bringing a couple of alternative food for thought points that listeners will ruminate on.
Yeah, and I mean that all of those decisions should be driven by investment time horizons, right? So if we take a master trust, for example, and let's say that they have, let's for argument's sake that they have a varied population in terms of they have some younger members, some people who are halfway through their journey, and some people who are just about to retire. I mean, we have different portfolios designed for those people to take account for the fact of how close they are to the point of crystallizing their portfolio. So it's about adapting how you are exposed to equities compared to where you are on your journey, right, relative to time horizons and how long you have to recover. But if, as you say, if you have 100-year, which is in human terms perpetuity, because we struggle to sort of like plan 1 to 3 months ahead, let alone 100 years. So that's a completely different question. As long as you're not trying to crystallize everything, you can just stick with whatever asset allocation you decide and just ignore it effectively, can't you? And just wait for the market to almost shake out and the new growth sector to re-emerge if once this one doesn't seem to be the growth sector anymore.
Well, I think that's a really good point, because if we were to think about the scenario in which you're an investor 100 years ago, 1925, how might you construct your portfolio then? It would be orders of magnitude different. Of course it would be. So we don't have the benefit of having a crystal ball and being able to decipher what will be the long-term winners and losers. But as investors, we do need to be alive to how the market is changing, what trends are emerging, what risks are on the horizon, and making adjustments accordingly. So that is, again, a really important takeaway for investors, regardless of their time horizon.
It's always fun to find those, occasionally you come across in those academic papers which list all the stocks that used to make up, for example, the FTSE 100. Yeah. And even going back to 70s, 80s, 50s, 60s, it's just hilarious to see how it changes and how rapidly it changes, and how no company really has. And there's very few companies now that are going to have a 100-year shelf life. And if they do, they're going to be ones that can adapt very rapidly. If we could go back to my growth question, because I'm a bit obsessed by this, I will admit, Jennifer, I might have to somehow, engineer a podcast around this. But to go back to the question about AI and tech and growth, I always feel, and maybe it's because I spend my life swimming in pensions, and so I talk a lot about demographics and aging population, but we do have a real, genuine challenge, don't we, in the developed world and increasingly large sections of the developing or Asian markets in terms of how our populations are aging. And it's quite a simple conundrum in that if you have people who are aging, a large proportion of the population is aging, who consume more from the state in terms of social care, pensions and healthcare, and a smaller and smaller proportion of that population that's working and providing growth and tax revenues. I think this quite frequently, I wonder if we've really come to terms with that conundrum yet, and whether we've really thought about where future growth or how we kind of adapt for that environment going forward, because there doesn't seem to be any indication of fertility rates or the number of children women are prepared to have rising again. So short of a sort of dystopian Handmaid's Tale nightmare arising, it doesn't seem like we're going to reverse that anytime quickly. Do you think about those kind of things? I know it's thematic and it's a long term, but do you think that we have really grappled with that yet and thought about how we're going to grow?
Yeah, so the first question was, do I think about these dynamics and how it may affect things? Yes, I do. And like you, I find this an absolutely fascinating topic because it's so multifaceted, and we are beginning to see this bite from a fiscal perspective. And we are all very aware of the lack of fiscal headroom that developed market governments have at the present time, and what that means for populations that are getting older, that are relying on more healthcare and more social care, but without the ability to create the fiscal expenditure required to sustain those services. So this is a deeply problematic issue. Of course, it's not just an investment issue, but it clearly has repercussions and ramifications for the investment world. And going back to your earlier point around the market narrative at certain points in time on paradigm shifts, that is something, of course, that we are seeing here with regard to how do we solve the productivity puzzle and the productivity challenge that has plagued developed markets for some time. So the relevance of that to tech, to AI, has been in sharp focus for some time now. So I think there is an element of seeking to address the problem through the innovations of the investment market. Now, it remains to be seen whether that will have the desired effect, but certainly these are long-term structural challenges that need to be considered very, very carefully, particularly in the context of running a portfolio over a long time horizon. And what that means, I know that this isn't today's topic, but what that means for government bonds and yields and the outlook for rates over time is also a crucial component to that.
Yeah, well, I mean, you mentioned at the start that, we touched on the fact that there's no reason to move away from the equity market. You mentioned how successful it's been. And of course, I've mentioned this before in this podcast, but it's worth mentioning again because it's such a fantastic sort of like role reversal. If we think about capital asset pricing model, which was developed to account for the fact that equities always seem to have a risk premium higher than bond markets. And that's been turned on its head in the last few years, where equities have been kind of not that volatile and bonds have been all over the place as we've played the guess where interest rates are going game for the last sort of 2 years or so. So yeah, it's fascinating, isn't it, how all of these things, and that feeds in, we can't ignore the bond markets, we can't ignore what's going on economically, macroeconomically, because it all feeds back into equity markets and how people perceive equity markets and how they perceive them as an engine for growth as well going forward.
Absolutely, ignore the bond market at your peril.
Yeah, exactly. So one of the things I think you touched on before, which I think I kind of like to end towards, at least, you talked about the triple T. One was tariff, one was Trump, and I've forgotten the third. And you mentioned how stock markets other than the US has actually been performing quite well, which hasn't happened for a very, very long time. It's almost as intangible as value outperforming growth, which hasn't happened for a very long time either. But has Trump sort of like, is it to be quixotic, has Trump done Europe a favor and actually made us look sort of moderate and calm, and our stock markets have performed better going as a result? And how do you see that kind of unfolding onto the I mean, I'm not going to ask you to predict what Trump's going to do, because even Trump doesn't know what Trump's going to do, but can you see that kind of like volatility and sort of ebbs and flows between relative performance between Europe and the US continuing over the next 4 years?
Well, one of the other stories I was considering for today's discussion was actually around the sectoral outperformance of defence as a sector. And there are a number, clearly, of very large defence stocks within Europe and indeed within the UK. So if we think about a number of names there, they have done very well over the past little while. Now, that is and can be viewed as a reaction to the geopolitical environment that we are in currently and some of the risk which is being priced in there. So I think there is something around sectoral composition, Charlotte, within European indices, for example, and that is coming through very much in those sectors. So you're absolutely right around the difficulty of predicting what the next moves will be. So it is natural, of course, for investors to look for what may deliver more stable long-term returns. We also have a bit of a lens of how the dollar has been behaving over the past 8 weeks or so. So that is an important factor as well for global investors that are seeking to mitigate some of the the dollar volatility risk that they're seeing as well.
Yeah, I saw some wild commentary on social media over the weekend where they were like, could Trump have it in him to basically topple the US dollar from being the global reserve currency, which really would be quite extraordinary, and could the euro take its place, which is definitely entertaining for the weekend. It's definitely something I'd like to see a lot more in-depth analysis before I started to entertain that idea. But, that is a big reason why the US economy has the strength it has. Obviously, it's also one of the world's largest internal and richest markets. But we are certainly living.
And we also have the lens that the US market is not a domestic market, of course, that there are so many large organizations that have chosen to list in the US because of the liquidity, market access, global participation of investors in those markets. So we ought to remember that as well, that the US market does not represent the US economy per se.
So let's try and bring this all together, because we've talked about so many different things. As I said to you on LinkedIn, we'll be able to cram an awful lot into half an hour. Let's bring this sort of together and say, what would your advice, given everything that's going on? We've talked about valuation, we've talked about growth, we've talked about, is AI and tech going to give us what we need? Are we undervaluing population impact? What impact are we going to see with Trump? Relative volatility of equity and bond markets, just as a quick canter through everything we've discussed in the last 26 minutes or so. So if you're sitting there as a professional investor, what is your counsel given all of this change and uncertainty? What's the best way forward to manage all of this? What's your final piece of advice?
Yeah, this is really key. So it's good to end on this, I think. The key thing is think about your sources of return. And I see many portfolios that I'm looking at and evaluating and considering whether there's other options that may apply to that set of circumstances that are quite concentrated in their source of return drivers. So there's another lens of concentration for us to think about. So what are the return drivers and how might that be expected to perform under different market conditions? So we like active diversifiers. We like core diversifiers. So those more highly liquid elements like hard currency, US treasuries, gold, which has been an absolute standout performer as well. So things that do well when equity markets tend not to do well. Having a balance of those within a portfolio is very important, where you are looking to smooth and stabilize your returns over time. So having the equity market driver there as the kicker of returns, as the generator of perhaps those inflation plus returns that you need to achieve, but what are the other constituent parts that sit around that to smooth out that journey?
I think that's a great place for us to end the podcast. And I just wanted to say thank you so much, Jennifer, for coming on to this episode of the Professional Investment Podcast. Thank you for sharing such a cracking news story with us and for all of your insights.
Thanks so much, Charlotte. It's been an absolute pleasure.
And listeners, I hope you've really enjoyed this show. Make sure you hit the subscribe button so you never miss a future episode. We're coming towards the end of series 2, but there will be a third series coming up soon. Make sure you engage with us. Please do comment. And if you're listening on Spotify, there is a poll for you to take part in. Thank you for listening.